Today, banking crisis incoming. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, the S&P 500 Banks Index finished down 6.6% after hitting its lowest level since mid-October, and its biggest one-day drop in over 2 years as investors fled the sector after tech industry leader SVB Financial Group launched a share sale to shore up its balance sheet due to declining deposits from startups struggling for funding and following crypto bank Silvergate's decision to wind down operations. Shares of SVB, whose operating segments include Silicon Valley Bank, slumped over 50% in their deepest one-day drop on record after the company announced a $1.75 billion share sale late on Wednesday. SVB is battling cash burn due to declining deposits from startups struggling with a venture capital funding drought. Unlike most banks, which are helped by rising rates, SVB Financial is generally hurt by them, Oppenheimer said, as its deposits base is generally made up of commercial customers who are rate sensitive. The slump in SVB Financial further soured the sentiment on banking stocks, which have been pressurized by a deeper inversion in the Treasury yield curve, a harbinger for a recession. Morgan Stanley analysts say lower 2023 net interest guidance at SVB is driven by cash burn among private companies that bank with SVB. This, according to the analysts, will cause SVB to bring more higher-cost sweep accounts onto its balance sheet, paying roughly the Fed funds rate to do so. The yield on the 2-year Treasury bond briefly jumped by more than 100 basis points above the yield on the 10-year Treasury note. That's the deepest inversion since 1981. San Francisco headquartered First Republic slumped 15% after hitting its lowest level since October 2020. The SPDR S&P Regional Bank ETF dropped by more than 7% to its lowest level since January 2021. And major US banks were also hit, with JP Morgan and Bank of America both down by more than 5%. The Silicon Valley raise got everyone nervous about people's capital levels and what deposits are doing. A lot of institutional investors don't feel great about owning certain banks right now, said RJ Grant, head of trading at Keefe, Brunner and Woods. It just gets people freaked out because Silicon Valley historically has been a very strong, well-run bank. If they're having issues right now, people are wondering what about other banks that are lesser quality and that don't have the reputation that Silicon Valley Bank has. Investors were still grappling with the decline of cryptocurrency-focused lender Silvergate Capital, which dropped 22% after saying late on Thursday that it planned to wind down operations and voluntarily liquidate after it was hit with losses following the collapse of crypto exchange FTX. Shares in Silvergate, peer Signature Bank, fell 9.4%, and as a result, Wall Street's 3 major stock indices closed lower on Thursday, and Friday's job report, of course, potentially could spur more aggressive interest rate hikes from the Federal Reserve. So the Dow Jones Industrial Average fell 1.66% to 32,254. The S&P 500 lost 1.85% to 3,918, and the Nasdaq dropped 2.05% to 11,338. Fed Chair Jerome Powell this week exacerbated concerns about upcoming interest rate hikes aimed at fighting stubbornly high inflation, and traders were betting that the chances of a 50 basis point rate hike at the Fed's March meeting were now around 60%, up sharply from a probability of 31% before Powell's appearances on Tuesday and Wednesday in Congress. There's a lot of anticipation around tomorrow's jobs report. We're going to get a slew of data in the next week and a half, said Mona Mahajan, senior investment strategist at Edward Jones, also citing inflation and retail sales report all due up before the next Fed meeting, which ends on March the 22nd. And earlier on Thursday, Labour Department data showed initial claims for state unemployment benefits rose 21,000 to a seasonally adjusted 211,000 for the week ended March the 4th, compared with economists' forecasts for 195,000 claims. While last week's increased jobs claims may be the first sign of the labour market slowing slightly, Mahajan wants to see more data points to establish a trend. The February non-farm payroll report is expected to show a payrolls increase of 205,000 after January's blowout of 517,000, which had already led markets to brace for a bigger US rate hike. Any proof last month's gigantic payrolls numbers was an anomaly would serve to reinforce the market anxieties around the Fed's response to it, said Mark Lucchini, Chief Investment Strategist at January Montgomery Scott. And with February wage increases expected to rise 4.7% compared to January's 4.4%, it feels like it's ticking in the wrong direction, even if we just meet expectations, said Mahajan, who will be closely watching the wage data. With investors already concerned that the Fed could over-tighten and cause a recession and hurt bank lending demand, there's an element of sell first, ask questions later with regard to contagion risk from SVB Financial for banks, said Lucchini. SVB closed down 60% at 106.04 after falling at one point by around 63% and hitting its lowest level since August 2016. Also weighing on the sub-index was Signature Bank, which tumbled 12% to $90.76 after its crypto bank peer Silvergate Capital disclosed plans to voluntarily liquidate. Silvergate closed down 42% to $2.84. On the bright side, though, General Electric closed up more than 5% after the industrial conglomerate reiterated its 2023 earnings forecast. Wells Fargo closed down more than 5%. Technology has also played a role in the broader market, paced by a more than 1% stumble in Meta Platforms. And PayPal also remained above the flat line after Chief Executive Daniel Schulman said the company was seeing better than expected performance across its business amid a pickup in consumer spending. In other news, General Motors fell nearly 5% after the automaker flagged a $1.5 billion hit from its voluntary separation program that will seek to buy out the majority of salaried staff. And elsewhere, the Charles Schwab Corporation fell 9.3%. The downside in Charles Schwab was triggered by the sale of a large block of 8.5 million shares, but some investors bought up the broker's own exposure to sweep accounts. Jonathan Golub, managing director at Credit Suisse, is among those with a bleak outlook for equities. He described an environment in which persistent inflation squeezes company profit margins and investors spurn stocks in favor of treasuries and other short-term debt, where yields are at their highest level for nearly 2 decades on some maturities. A 6-month treasury yield effectively guaranteed at 5.25% changes the dynamics for investors when the stock market looks shaky, he said. You would need to get risk-adjusted returns in equities of at least 1 or 2 percentage points more than that. So in that environment, stocks are not worth the effort and are dead money. Golub expects the S&P 500 to end the year near 4,050, about 1.5% above its current level, and offer annual returns in the low single digits through as far as 2025 as inflation falls more gradually than many investors expect. A flatlining of US equity returns would serve as a harsh turnabout for investors who garnered annual gains of 16% or more in the S&P 500 in 4 of the 6 years ended in 2022, as interest rates sank to historic low levels. Equity valuations, meanwhile, look stretched, given the likelihood that rates will remain elevated, dampening future returns, wrote Nicholas Colas, co-founder of Data Trek Research, in a report this week. The S&P 500 trades at 17.5 times Wall Street analysts' expected 12-month future earnings, which we continue to believe is simply too high given the uncertainty around rate, policy, economic growth, he said. We remain therefore cautious on US equities. And at the same time, history suggests that when the Treasury 3-month bill rises above that of the S&P 500, as happened earlier this year for the first time since the dot-com bubble, cash typically outperforms equities, analysts at Capital Economics wrote in the note on Thursday. We suspect treasuries will also outperform US equities later this year as the biggest tightening of Fed policy in 4 decades finally takes a toll on the economy, the firm noted. Still, stocks have managed to hold on to their year-to-date gains so far, even as bond yields have risen, with the S&P 500 about 4% and the Nasdaq Composite up nearly 11%, but some investors believe markets will continue to grind higher. You can still make money in stocks, but you need to be in the right segment, said Nancy Tegler, CEO and CIO of Laffer Tegler Investments, in a recent note. So cyclicals do well in this particular environment, and that's what we're focused on. But Max Westerman, senior portfolio manager at Miramar Capital, believes the Fed needs to raise rates by another 100 basis points in order to tame inflation, producing an environment that will likely be unfriendly to US stocks. Westerman is focusing on dividend-paying stocks and bonds, which he believes offer more attractive short-term returns given that valuations remain stretched. He does not expect the equity market to have a sustained rally until the Fed begins to cut rates in the second half of 2024. You no longer have to hold your nose and invest in stocks because there's no alternative, he said. And cryptocurrencies fell along with stocks exposed to the asset class after Silvergate Capital said that it will wind down operations and return cash to depositors. Silvergate has been a key provider of banking services to crypto exchanges in the US, and it is far from clear how they will find anyone else to facilitate the transfer of money between the crypto and fiat currency universes. Bitcoin fell to its lowest in a month before recovering slightly to trade around 21,000 US, while Ether, Cardano and Solana all fell too. Other indicators suggest that crypto investors continue to pull their money out of the space, with the value of Binance US dollars outstanding circulation falling to barely $8 billion. That's a drop of 50% in the last month, despite Binance saying that it has no exposure to Silvergate. So, two takeaways from here. The banking sector is now highly exposed to what's going on here. And I think we can conclude that is true not just in the US, but in other markets too. And of course, we're not talking yet about higher bad debts, but they are to come given the higher interest rate environment. And secondly, the crypto environment continues to sour, and we will expect to see more of that too. There are investment alternatives, but you have to be really careful just now. And certainly, equities look well overvalued, and the markets are due for a further correction. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.